I'm joined now by Anthony Chan. He's the former chief economist at JP Chase. I want to thank you for joining us. What do you make of this downward revision?
Well, I think it's a sign that the economy is slowing down. People will say it's only a tenth of 1%. It's not a big deal. But if you look at the components, namely consumer spending, which is 2/3 of your overall economy, that one was sharply revised lower to 1% from 1.4%. And then something that nobody talks about, and that is that we can measure how much economic activity took place in the economy in two ways. We can look at GDP and we can look at gross income, gross national income. And that one actually was much weaker, was reported at minus 1.1% for the quarter. Now, the way the National Bureau of Economic Research likes to measure these things is they like to often take the average of the GDP and the income one. And when you do that, you get a number that's about 0.7%. That number is just too weak to give me a lot of comfort. If there is a silver lining, and that is that we see a lot of positive growth in the first quarter, but as you move beyond the first quarter, I think that the probability of a significant slowdown increases.
So what areas, what sectors are thriving right now?
Well, right now you see that the travel industry is doing okay. People are trying to enjoy experiences, but you're seeing some other components of consumer spending, like the goods component, being a little bit weaker. And then to the extent that you see overall economic activity slowing down eventually because liquidity is drying up. We know the money supply, the latest numbers show that M2 is now growing. It's actually contracting at the fastest pace we've seen in close to 63 years. Historically, when you see that, about a year later or a year and a half later, you do see the possibility that the economy either slows down or potentially goes into a recession. I certainly don't want to call for a deep recession, but at least a mild recession, I think, is in the cards, given the fact that the money supply is so weak and given the fact that banking credit will get a lot weaker because this banking crisis, no one can argue, is actually a positive for the economy. It's a negative. The question is, how much of a negative?
Okay, so as you throw out all these different factors, and they're all important, you know, some of these things can kind of build on each other, and you can start to see an acceleration. I mean, what would be your forecast looking forward?
I think that by the end of the year, say the fourth quarter, you could probably start to see economic growth that is more consistent with a recession. By the way, I hope I'm wrong. I don't want a recession. But as I look at the indicators out there, they do suggest that by the end of the year, you will see at least a mild recession. This is not going to be a recession like 2020. It is not going to be a recession like the global financial crisis. It's going to be milder because regulators, people at the Fed, people in the administration, they all don't want to see an economic collapse. So they're going to go out there and try to support the economy. So I think you probably get just a mild recession, but a mild recession is still something that nobody wants to see.
Yeah, you know, the Fed has talked a lot about this soft landing. I've heard some folks say, look, the wheels are coming off, the wings aren't in great shape. I mean, how do you see it in terms of trying to steer this so that there is a soft landing?
Well, Mike, I'm glad you brought that up, because if you look at the economic projections of the Fed for this year, they're basically almost unchanged. You got about a 0.4% growth that they're expecting. Next year, they're expecting 1.2%. Anytime you take an economy the size of ours and you're projecting economic growth that's less than 0.5%, that is so weak that it can easily tilt in either direction. So the risk is clearly there. But I think that the fact that they actually talked about the possibility at some point they may pause or they may even stop raising rates aggressively suggests to me that the Federal Reserve is not going to let all the wheels collapse or all the wheels fall off the wagon. They're going to make sure that they moderate it. And they already warned you by telling you that because of this banking crisis, maybe some of their work or some of their Fed tightening is being conducted by the crisis itself, which means they have to raise rates less aggressively. That will probably mean it'll take a little longer for inflation to go back down to its target, but it will also minimize the severity of the next recession. And that's good news.
So if you had a chance to talk to the Fed chair, what advice would you give him?
I would tell the Fed chair that you have to fight inflation, but you also realize that in doing so, you may cause a recession. So you want to fight inflation, but you want to fight inflation less aggressively. And what does that mean? That means that at the most, you want to raise rates one more time. I would even advise them to pause at the next meeting on May 3rd. And then if the economy is still hanging in there, then you could always do it at the next meeting. So again, why didn't they do it this time? It was a little dicier because the market was expecting the Federal Reserve to do something. And given its proximity to the banking crisis, the risk was that they could have really spooked financial markets into thinking things were a lot worse. But by May 3rd, if the economy is still hanging in there, they do have the option and the ability to pause and raise rates another quarter percentage point, but no more than that. Because I think that at that point, you run the risk of causing a recession that is a lot stronger than anybody wants to see.
All right, Anthony, if they pause, we know they're watching this broadcast and they're listening to you. So thanks so much for imparting your wisdom to us tonight. Appreciate it.
Thank you.